Hello and welcome to AI Market News by LM. Today we are diving into a market that's telling two, well, completely different stories. So what in the world is driving this split? And what does it mean for the weeks ahead? Let's get into it. We're gonna unpack a really fascinating day where the main event was a blockbuster US jobs report. I mean, this thing sent shockwaves everywhere. And the big question on everyone's mind now is this the start of a major shift in investor strategy? So let's kick things off by looking at exactly how the day played out. First up, let's get a quick snapshot of how the major US indices finished up. And as we're about to see, the numbers really reveal a puzzle, a genuine tale of two completely different markets. Okay, so check this out. It's a clear split. On one side, you've got the Dow Jones closing solidly in the green, up over 0.5%. But then, on the other side, the tech-heavy NASDAQ is down almost 0.5%, and the S&P 500 barely budged. Now, this isn't just random market noise, folks. This is telling us a very clear story about where the money is going. And that story is all about a significant market rotation. It looks like investors are pulling money out of those high-flying AI and mega-cap tech stocks, the ones that have been leading the charge for so long, and they're putting it into more traditional, shall we say, value and defensive stocks. So what's causing this big shuffle? I mean, what's the driver here? To get to the bottom of it, we've got to look at the underlying sentiment. Let's try and gauge how investors are actually feeling right now. To really get a handle on all this action, we basically need to take the market's emotional temperature. Is the vibe right now fear or is it greed? And a great way to do that is with the Fear and Greed Index. Think of it like a pulse check for the market. It mashes together 7 different indicators, things like market momentum and junk bond demand, to give us a score from extreme fear all the way to extreme greed. And would you look at that? The needle is pointing firmly into the greed zone. This tells us that right now, investors have a pretty healthy appetite for risk. And that helps explain why they're so willing to jump ship from one sector to another, looking for those new opportunities. So what's feeding this greedy feeling? Well, it's a couple of key things. First, market momentum is solid. The S&P 500 is sitting comfortably above its long-term average. And we're also seeing a lot of demand for riskier assets like junk bonds, which is a classic sign that investors are feeling pretty confident and are chasing higher returns. Okay, now let's get to the main event, the one piece of economic data that is really pulling all the strings and making everything we just talked about happen, the December jobs report. This was it. This was the report everyone was holding their breath for. It gives us the clearest possible picture of how the US labor market is doing, and that has massive implications for what the Federal Reserve is going to do with interest rates. All right, let's break down the numbers that are shaking things up. First up, the big one, the headline job creation number. And right alongside that, the unemployment rate actually got even tighter, pointing to a very strong labor market. But here's the real kicker, the one that hints at inflation. Was this jump in how much people are getting paid? So let's put it all together, because this is the crucial part. The economy added 66,000 jobs, which beat the forecast. The unemployment rate dropped to 4.5%, which was better than expected. And this is the big one. Wage growth came in at 0.3%, more than doubling what everyone thought it would be. Across the board, this report was hotter than expected. The economy is running strong. Now, a strong economy is good news, right? Well, for the market, it's a little more complicated than that. Let's see how this surprisingly strong data is actually translating into market moves. And this brings us right back to that split we saw at the beginning. See, a hot jobs report is great for the overall economy, which is why the Dow rallied. But for tech stocks, it's kind of bad news. It suggests the Fed has absolutely no reason to cut interest rates anytime soon. And that idea of higher for longer rates, it really hurts tech valuations because it makes all their promised future profits worth less in today's money. And this whole higher for longer narrative isn't just hitting the stock market. Oh no, it's having a huge impact in the currency world too, giving a major boost to the US dollar. We can see that strength playing out right here. The idea that US interest rates will stay higher for longer makes the dollar a much more attractive investment. And as a result, we're seeing it flex its muscles, gaining ground against both the euro and the Japanese yen. So, with all that in mind, where do we go from here? Let's take a quick peek at the economic calendar to see what major events could stir things up in the coming weeks. Okay, so we're looking at the calendar from investing.com, and there are definitely a few key dates we should all be circling.
Things are going to get going next week with the start of earnings season. We've got the big banks reporting on January 13th, followed by a key tech player on the 15th. But the really big ones, the ones to watch, are the central bank meetings. We've got the Fed on January 26th, and then the European Central Bank on February 5th. These are going to be absolutely critical for market direction.
And that leaves us with a million-dollar question as we head into the next few weeks. With the labor market this strong, is this rotation out of tech and into value going to continue? Or will those AI megacaps that have basically carried the market find their footing and take back the lead? That right there is the central tug of war we'll all be watching. This video is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion. Thanks for watching. Don't forget to like and subscribe.